Welcome back to our channel. Have you ever felt that sinking feeling when you realize your car is worth less than what you still owe on it? You're not alone. Right now, millions of drivers are trapped in negative equity, watching their monthly payments disappear into a financial black hole. But here's what the dealerships and lenders don't want you to know. There are proven strategies to escape this trap, and some of them might completely change how you think about car ownership forever. I'm about to share 5 powerful methods that can get you out of negative equity, including one controversial technique that financial experts debate, but savvy car owners swear by. Stay with me because by the end of this video, you'll have a complete roadmap to financial freedom from your underwater car loan. Please don't forget to like, share, and subscribe to our channel. Your support is desperately needed to keep money saving and insightful content coming to the general public. But first, let's make sure we're on the same page about what negative equity actually means. Simply put, you're upside down on your car loan when you owe more than your vehicle is worth. Maybe you bought a new car that depreciated faster than expected, or perhaps you didn't put enough money down. Whatever the reason, you're stuck making payments on a loan that exceeds your car's current market value. This situation is more common than you might think. Industry data shows that nearly 40% of car owners with loans find themselves in negative equity at some point. The average amount people are underwater? A staggering $5,000. That's not pocket change we're talking about. Now, why does this happen so frequently? New cars lose value incredibly fast. Drive a brand new vehicle off the lot, and it immediately drops in value by thousands of dollars. Within the first year, most cars lose 20 to 30% of their value. Meanwhile, if you finance the full purchase price or took a long-term loan, you're barely making a dent in the principal balance during those crucial early months when depreciation hits hardest. Here's where things get interesting. Most people think they're completely stuck until they pay down the loan naturally. That's exactly what the system wants you to believe. But smart consumers have discovered ways to break free much sooner. Method number 1 is the most straightforward but requires discipline. Make extra payments directly toward your loan principal. Every additional dollar you pay beyond your minimum payment chips away at that negative equity gap. If you can swing an extra $100 or $200 monthly, you'll be amazed how quickly you can flip from negative to positive equity. Here's a pro tip that most people miss. When you make extra payments, specify that the money goes toward principal only. Otherwise, some lenders might apply it to future payments or interest, which defeats the purpose. Call your lender and explicitly state where you want those extra dollars directed. But what if extra payments aren't realistic for your budget? That brings us to method number 2, the strategic trade-in timing approach. This requires patience and market awareness, but it can be incredibly effective. Car values fluctuate based on market conditions, seasonality, and demand patterns. Certain types of vehicles hold value better during specific times of year. Convertibles and sports cars often peak in value during spring and summer. Four-wheel drive vehicles typically command higher prices before winter. By timing your trade-in during peak demand periods for your specific vehicle type, you can minimize your negative equity or even eliminate it entirely. Research your car's value trends using multiple sources. Don't rely on just one valuation tool. Compare prices from dealer trade-in offers, private party sales, and online marketplaces. Sometimes the difference between these channels can be significant enough to impact your equity position. Method number 3 is where things get creative. Consider refinancing your current loan to better terms. If your credit score has improved since you originally financed the vehicle, you might qualify for a lower interest rate. A reduced rate means more of your monthly payment goes toward principal instead of interest, helping you build positive equity faster. Some people overlook this option because they assume their current rate is locked in stone. That's not true. Shop around with banks, credit unions, and online lenders. Credit unions especially tend to offer competitive rates for auto refinancing. Even a 2 or 3% reduction in your interest rate can save thousands over the life of your loan. Now we're getting to the controversial method I mentioned earlier. Method number 4 involves gap insurance claims, but only under very specific circumstances. If your car is totaled in an accident or stolen, gap insurance covers the difference between what your regular insurance pays and what you still owe on the loan. Here's the thing most people don't realize. Gap insurance isn't just for catastrophic total losses. Some policies cover substantial damage that makes the vehicle uneconomical to repair. before you dismiss this as insurance fraud, understand that legitimate claims happen more often than you'd expect. Weather damage, flooding, theft, and accidents create opportunities where gap insurance fulfills its intended purpose. Obviously, you should never intentionally damage your vehicle or manufacture a claim. That's illegal and unethical. But understanding your coverage options helps you make informed decisions if unfortunate circumstances occur naturally. Method number 5 is the most radical but potentially most rewarding. Sell your car privately and take out a small personal loan to cover the negative equity difference. This approach requires courage because you're essentially betting on yourself to pay off a smaller personal loan faster than you'd eliminate the negative equity naturally. Here's why this can be brilliant. Personal loans for small amounts often have shorter terms than auto loans. Instead of being trapped in negative equity for years, you could be debt-free in 12 to 24 months. Plus, you eliminate car insurance, maintenance, and registration costs immediately. The math works like this. Say you owe $15,000 on a car worth $11,000. Sell it privately for $11,000, take a $4,000 personal loan to pay off the remaining balance, then aggressively pay down that personal loan. Personal loans typically have higher interest rates than car loans, but the shorter term means you pay less total interest. This strategy works best if you can live without a car temporarily or switch to a much cheaper vehicle. Urban dwellers with good public transportation often find this approach liberating. Rural residents might need to purchase an inexpensive used car with cash. But let's talk about prevention because avoiding negative equity in the future is just as important as escaping it now. When buying your next vehicle, put down at least 20% if possible. This cushion helps offset immediate depreciation. Consider certified pre-owned vehicles that have already absorbed the steepest depreciation hits. Avoid extended loan terms longer than 5 years. Yes, longer loans mean lower monthly payments, but they also mean you're underwater longer. The sweet spot for most people is 3 to 4 year terms that balance payment size with equity building. Here's something dealerships won't tell you. Sometimes it's better to wait and save more money rather than buying immediately. Every month you delay buying while saving for a larger down payment potentially saves you thousands in negative equity stress. Now, if you're currently dealing with negative equity, don't panic. This situation is temporary if you take action. Start by getting your car's current value from multiple sources. Know exactly how underwater you are so you can make informed decisions. Consider your personal situation honestly. How long do you plan to keep this car? If you're thinking about trading up in a year or two anyway, aggressive principal payments might be your best bet. If you love your car and want to keep it long-term, refinancing could reduce your monthly burden while slowly building equity. Remember, negative equity only matters if you need to sell or trade your car. If you're happy with your vehicle and can afford the payments, sometimes the best strategy is simply waiting it out while making regular payments. The key is taking control instead of feeling victimized by the situation. You have options, and now you know what they are. Pick the strategy that fits your financial situation and risk tolerance, then execute it consistently. Your future self will thank you for taking action today instead of hoping the problem solves itself. Which method resonates most with your situation? Let me know in the comments below, and don't forget to subscribe for more financial strategies that actually work in the real world.